Welcome, everybody. It's On Track Wealth Management's Market Insights for Q3 2026. I'm here with Jimmy Burns.
Jeremy, how are you?
I'm good. I'm a little tired today. I
Yeah,
was kind of telling you that. I didn't sleep well last night. So,
you're a warrior.
I'm a warrior. I'm here. I'm here, man. But excited to do the Market Insights as always. Here we are at the end of July, looking at the markets and kind of trying to have a little bit of fun with it too.
Let's do it.
So the points here, we're going to take a look, do a halftime report. So we're a little bit more than halfway through the year. Then we'll talk about how we want people to diversify, don't hoard.
Yep.
We'll break that down. And then 250, can you imagine what that's all about?
Right. 4th of July.
4th of
That was
July,
a big
America's
one.
250. We'll kind of like talk about a little bit of America's prowess in the world and have a little bit of fun with it with a couple of slides.
I love it.
All right, here we are. This slide tells a lot.
Yeah.
Okay, so you've got oil, you've got stocks, and you got bonds in here. So break it down for you real quick. The big purple one right there, that's oil. That's Brent crude. That's the global benchmark for crude oil.
Right.
Boy, oh boy, is it spiked, right? We know where it did it. It was the Iran war,
Yep.
right? And it kind of jumped around, settled back down when we had a ceasefire.
Right.
Here we are, unfortunately, again, where the ceasefire is being broken, and you can see it's breaking out again.
Right. Yeah. I mean, I think you can see a pretty clear delineation here too in the chart as you move from left to right. When you get to the beginning of the war, and it looks like in March it started to tick up slightly and then kind of went parabolic.
Yeah,
And if you look at the corresponding assets that we're tracking the performance here of, small cap stocks, emerging market stocks, U.S. stocks, and um, other international stocks, your developed economies, you can see a clear erosion in the returns as the price of oil started to go parabolic.
no doubt. I mean, it was already sort of a softer first quarter of the
Right.
year, and
Yep.
then this hit in March, and it really drug everything down with it. Then the market started to rebound, as you can kind of see there, and about the middle of April started to rebound.
Right.
It's sort of one of these things that we know about geopolitics and the strife that's international a lot of times is going to have a pretty decent impact at first, but then the market kind of adjusts,
Right.
washes it away. Doesn't, I don't say it washes it away. I want to say that it adjusts.
Right. I think that's a good way of saying it. But the story literally was for a little while there. Oil was up, stocks were down. If oil was down, stocks were up. I mean, it was just a very predictable. Once you saw what the price of oil was in the morning, you had a pretty good feeling of what the market was going to do that day.
Agreed. So the other things you're seeing in here, look, there's no doubt about it. The Russell 2000, which is the small cap ETF indicator, so it is killing it.
Right? It's having a great
Having
year.
having its best year. We looked back on it. Some were saying, I heard in the news, best year since 2003. We looked back and it had a great year in 2013 as well.
Right.
So look, it's over a decade.
Yeah.
It's had any type of performance like it's having right now.
Yep.
So that's cool. But bonds, on the other hand,
Not
not
so
doing
much.
so well.
Yeah.
The bond market has been a little bit spooked by this war, and I think the context there is that it's inflation.
Right. Well, I think there was, obviously we talked to a lot of different asset managers, and if we were to go back to the beginning of this year, I don't think that rate hikes were on anybody's bingo card,
Hmm.
right? Or at least the probability of rate hike versus rate cut. It was far more probable that we would get a rate cut before we'd have a rate hike,
Right.
right? But here we are, and so bond prices have sort of been stuck in this. I don't know. By the way, we have a new Fed chair.
Yeah, there's a lot of change.
You're right. So, you know, uh, year to date, not the most exciting performance in the fixed income, but there's a reason why you hold in your portfolio.
Right, absolutely. And what I try to explain to people about bonds is that, some of the stats around them are if you have a yield to worst, say it's 5%,
Yep.
90% of the time when you look forward 5 years, it produces not that 5%.
Right?
So it's consistent over a longer period of time. In a short period of time, you're going to get volatility just like you're going to get within the stock market.
Absolutely.
Here's a look at sort of the economies of the world. broken out, and sort of this is an economist slide. Let's just put it that way.
Right.
You've got a lot of data here. U.S. 2.1% growth. That's a little under the global growth rate.
Mm-hmm.
You got inflation still sticky, 3.5%.
It's tough. And again, you go back to the bond prices, and are we going to raise rates? Are we going to cut rates? Again, new Fed chair. This slide here, it certainly seems like the Fed is going to be cautious, right? And Kevin Warsh, the new Fed chair, not super transparent on the way he feels about the markets and what his the influence that he hopes to have over the markets is going to be. But I think one of the things when you think about the international markets and the currency, so U.S. dollar being weaker, in line. Um, but again, the whole interest rate differentials relative to the rest of the world, and what is the ECB doing, what is Japan doing with rates, and what are we going to do? There's still a lot of uncertainty there right now. So the currency is certainly something that we keep a close eye on, relating to international investments.
Right. As we often teach, it's a tailwind when the currency is a little weaker.
Right.
So the our international funds are doing better as a result of that, if nothing else.
Right. For
They've
sure.
also had some really good fundamental growth as well.
Yep. Agreed.
This is interesting. We talk about concentration risk a lot in investing,
Hmm.
and one of the things that's kind of stood out in recent years is, we were talking a lot about the Magnificent Seven in the
Yeah.
last few
Right.
years, but let's say the top 10 companies inside of the S&P 500, they're now representing nearly 40% of the market cap weight of that benchmark.
Yeah.
That's big.
It
That's
is.
bigger than it's been since I want to say the 80s.
That sounds about right.
Yeah. So, is it a little bit of risk associated with your portfolio? Well, probably if you're just in the S&P 500, yeah,
Right.
probably.
I think one of the things that is most important to think about when you're buying an index or a an index fund that tracks a benchmark, I think it's important to understand the construction of that benchmark, right?
Yeah.
And that's where I just don't think that, maybe sometimes there's a narrative that, index funds or funds that track certain benchmarks are much less risky than those that have active stock picking going on in them. And maybe now you're at a point where it's not as diversified as what you thought it was when you got into the investment, maybe a decade plus ago. Right. So the need to constantly evaluate and understand what you hold and why you hold it, and is this what you want to continue to hold? I think it's critically important to understand the dynamics of the underlying holdings of each of these benchmarks.
I love that point. I think that's a great point. I think also it just dovetails really nicely with in a nice diversified portfolio. Sure, you want to have some passive benchmarks in there. We're big believers in that.
Absolutely.
And in fact, if you're talking percentages wise, it should be a plurality of what you own. But there's also an opportunity for some active management over top of that as well
Right.
that can go in there and dice things a little bit differently according to whatever their philosophy is with their fundamentals or the momentum or whatever it might be.
Right.
And they
Absolutely.
can take advantage of that, and you can be the beneficiary as the investor. So yeah, we are always looking out for concentration risk in anybody's portfolio when we're kind of examining it, and just it's noteworthy to see some of these benchmarks getting more and more concentrated.
Correct.
So then you get valuations. It's not surprising that valuations are higher. They have been higher for the last, you know, save, 22, 23 time frame.
Right.
Valuations have been elevated for it feels like years.
Right. Yeah. So relative to the 25-year, what are we talking here? 30-year average, we're basically at one standard deviation. We're coming down, which is, I think that speaks to the broadening out trade. And the Magnificent Seven haven't been as magnificent
Right.
year to date. So, you got to remember what we're looking at here is the price of stocks relative to the earnings per share. And that's ultimately what you're paying for when you're buying stocks, is you're paying a price for the earnings of, said company, right? So to see the Magnificent Seven stocks not doing as well year to date, and the valuations have come down to be at one standard deviation above the long-term average, but the market is still positive for the year. So when your valuations are coming down, right? That means that you're earning more per, if you're not paying more from a price perspective, you're paying a little bit less. The earnings are justifying the actual growth in the price of the market that we've seen.
Spot on. And this is known to be an earnings-driven rally
Right,
or, bull market
right,
of late. They call it this year.
right.
So always diversify,
Yep,
right? We love this periodic table. So much data in here, so much fun stuff to look at. Once again, in white, and it's tracked throughout the all these years, is the asset allocation 60/40.
right.
It's a fairly stock and standard asset allocation for investors and sort of becomes its own benchmark. And it's still continuing to really, I would call it outperform.
Right.
And there's a lot of reasons for that.
Yeah, so when you're looking at these, so you got year-to-date performance on the far right. Commodities, no surprise, given the chart, a few charts ago with the price of oil, and we saw how much the Brent crude has, increased year to date. Doesn't surprise me that commodities are at the top. Again, small caps, we just talked about this, having an awesome year. I do think it's interesting to see, the real estate, the REITs have not been very good the last few years. And we're starting to see, the REITs perform a little bit better. So again, that really jives with that the broadening out trade that we just talked about. You're seeing the price to earnings ratio come down in a year where the market is still performing well, positive returns. So I find those to be interesting points. And then, flipping to the far left, where you're looking at the annualized rate of return of each of these asset classes and the volatility in the column right next to it. Small cap stocks are volatile, right? And so you see there's a couple years where it's at the top, and then a few years where they're closer to the bottom. But right now we're in one of these, really nice markets for the small cap stocks. Again, getting back to the label on this chart though, diversify.
Right.
The importance, like sometimes it's at the top, sometimes it's close to the bottom, and you don't want to be, going too hard into some of these asset classes that have that level of volatility, unless you've built a plan that you understand the risk and the risk reward trade off for the way you have your portfolio allocated.
Yeah, I think it's a great point. And the other thing that you see in here is that it's so obvious why the asset allocation is having a little bit of a downward year to date compared to say last year.
Yeah,
It's the fixed income. The fixed income is at 0.1% growth for the year,
pretty
right? And
pretty
so
boring.
that's 40%
Yeah,
of a 60/40.
right.
Once that starts to perform, once that starts to revert to the mean, if you will,
Yeah,
you're going to see this asset allocation piece jumping back up. And that could happen really at any time. Um, but and the other thing you can note in there, and it's important, is that it's a weird year in the sense that cash is actually outperforming fixed income. That is typically not the
that
case.
is typically not the case indeed.
So that is an unusual bug in this year's system.
Correct.
Which leads us to our next slide here. Anecdotally, we've seen some of our clients holding on to larger sums of cash, and that goes back to this consumer sentiment that is still pretty low in the compared to the averages,
Right.
and just this unusual feeling in the in the investors landscape where things are going really well and they've done really well. It's hard to complain about a lot of things when people look at their 401ks. They've been up, up, up,
Right.
but people don't typically feel very good about their financial situation.
Yeah. And there's obviously a number of behavioral, biases that impact the way people feel. But I love seeing this because when you do see, individuals with a lot of cash on the sideline, maybe more so than what they really need, I think this is a great chart to sort of create some proper perspective of the potential cost that holding on to this much cash is having on, your financial potentially your financial independence in the long run. If you're continuing to hold too much cash, it can be a real drag on the return of all your assets, and therefore it might not be the best result for you in the long run. So I do like looking at this to see, okay, look, once you start looking out over longer periods of time, once you get to 3 years and beyond, man, having that extra cash sitting on the sideline, it really is, not very
It's
smart.
detrimental, and you get into a real smooth board spot here in the charts. Once you hit the 1 year mark, the 60/40 investment compared to the cash investment is giving you a better rate of return 80% of the time or more.
Right.
So it's really just it becomes a very strong business case for like how you do this. But again, you spoke to it earlier. It's a psychological thing.
Right.
And we're not suggesting that people should get uncomfortable with what they're doing from an investment standpoint, but we just want you to think logically
Right.
and think about the long term. If you need money in the short term, we're definitely not suggesting that you should put that money into the market from a financial planning perspective.
Sure.
It's always smart to have cash,
Yeah.
but how much
Yeah.
is the real
Agreed.
question. All right, we're gonna have a little fun with this. This is America at 250. Capital Group put out a couple of slides here that we thought were interesting and fun to share. And it's sort of this is a good story right here for sure. When you look at the U.S., we're 4% of the population,
Yeah.
and yet we've got a lot of good things going for us financially, and you could say even culturally.
Right.
So, you know, 27% of the gross domestic product.
That number really, I mean, it doesn't surprise me, but when you think about that as 4% of the population,
Yeah,
it's an astounding
it
number.
really is. Top 100 firms, 83% of them. Top 50 sports franchises, okay, 88%. Interesting, right? Given the fact that, like football or soccer,
Right. We just
as
saw
we
that
call
the
it,
World Cup
is
end.
one of those huge international sports, and we don't really participate in that at the same level as most of these countries do.
Yep.
At
Right.
least we haven't historically.
Right.
It's interesting to see that we still have 88% of the top
That
50.
is really that's intriguing.
And then the highest grossing movies. I don't know what that tells us,
Yeah.
but it tells us something, right?
Sure.
Hollywood puts out some product, people like it, they spend a lot of money on it.
That's awesome.
Okay. Maybe a little bit more incisive here when it comes to finances is this. Americans have often been early adopters of technology.
Right.
I don't think that's any surprise to people who are living today,
Sure.
but it's really goes back in time.
Yeah. We were talking earlier like the different industries that we've seen the investment because we're kind of living through it now with the AI, right? And how much money is being spent on AI, and America is clearly the biggest spender at this point. I think go back and you look at these other industries that have changed the world, so to speak, at different points of time in history, and we're right there at the top in all these major industries. So no
Yeah,
surprise that that's where we're at today.
it's no surprise. You could see a fourth graph in here for AI
Yeah,
eventually,
it's
for
coming.
sure, right? So we had railroads, right? We were a huge adopter of railroads. Telephones. The Germans like the telephone more than us, apparently, but just a little bit. And then the personal computers. So those are, personal computers kind of leads us to this AI
Right.
era. It's going to continue to be interesting to see how this plays out, but certainly, like you have the United States as a huge investor, that the capital markets, massive investment. China is doing a good job of investing in the AI space as well.
Sure.
A little bit more on the robotics end
Right.
than sort of like the compute side
Yeah.
that we're going for. But collectively, obviously, there's a race going on,
Absolutely.
which leads us to this R&D spending. Okay, so
There we
here we
go.
are. U.S. leads the world again by a pretty strong margin.
Yeah, I mean, again, we're an economy where entrepreneurship has been rewarded, and really going out and trying to develop new technologies and services and products that are going to help better others' lives and grow the economy, and we clearly are all in on spending to continue to develop.
Right. So this is part of our culture. This is who we are as a people, and we should all take pride in the capital markets that we have and the entrepreneurship
Right.
and the fact of the matter is that the United States is a little different than say Europe when it comes to people wanting to start a business and wanting to make a difference with that business versus that stuff is not culturally, it's just not seen the same in all countries.
Right.
So
Yeah.
here we are, we're different.
Yep.
It's paying dividends, and we've got to be proud of that.
I would agree.
Well, that's all we had.
Love it.
So if anybody needs to get a hold of us, here we are. we're working this summer,
That's right.
and of course, as always, we're thinking about finance. Even if you're not, you're out on vacation, you're out at the beach, enjoying the sun, maybe enjoying the smoke. Hopefully not,
Hopefully not, right?
but hopefully that clears up. But yeah, we're here if you need anything. So just give us a holler.
All right. Thanks, Jeremy.
You got it, buddy.